Hello. I got a few requests over the past week because I had to rush through the whole derivatives episode because we had so much to cover. Thinking about, that I thought I could be able to manage it within 30 minutes, but clearly it wasn't to be. So I did rush across and use many new words that I never actually described as I was talking about them just because they're so natural to me. So this is more like an annex video. It's not live right now. It's not live at all. Actually, there's no live audience for this. But I just wanted to add this on as an annex to my episode number 6. Just the usual disclaimers before we dig right in. This is not financial advice. It's only my opinions, my ideas, my thoughts, or my understanding of what's happening out there. It's only to educate yourself as a viewer or my peers to try to help them understand like in this case, how derivatives work, so to speak, or other content that's been previously recorded or mentioned. And content is being recorded, obviously, too. If it's on YouTube, it's being recorded. Right. So, just this there's no slides for this. I'm just going to carry forward the slides from the last episode. So, derivatives. I hope you understand the point of leverage. Just think of it as a lever. Utilizing capital you don't have to get into positions that won't otherwise allow you. You're basically leveraging yourself. Again, you need to understand this concept extremely well. The idea of buy to open, sell to close, buy to open, sell to open, and buy to close. So they're basically pairs that work with each other. So obviously, if you buy a stock, you have to close it to get your cash back. Or as you pass away, as you die, somebody inherits stock, and the that's the only way you don't sell to close. And the same for sell to open. You have to buy the option back, even if it's at zero. It's still buying to close your position. So if you sell to open a contract and after some time the contract is worth zero, then the profit is your difference between your selling price and zero. That's your entire. That's what shorting a stock can potentially be, if that makes sense. Of course, you will pay for the you will pay a premium for the ability to do that. Right. So, as I mentioned, the world by default is net long because it's the easiest thing to access for most people. They can't access. Some people can't access these kind of derivatives. Some people can't access those kind of derivatives. And derivatives or leverage is mostly available to more sophisticated people who kind of know what they're doing before they begin to seriously lose money. Which is why the world is by default net long. Leveraged ETFs. This is the easiest instrument we discussed the other day. Again, the point, I'm not going to go over this again because I don't think it's worth spending more time on them. They do what they say on the tin. Three times Tesla, three times Tesla. Maybe you will get 2.5 times over that holding period, or 3.5 times. It's completely dependent on what the provider is holding within their portfolio to give you what they're saying within the ETP or ETC. Uh, sorry, ETP. Yeah, they're often referred to as ETPs because it's an exchange traded product rather than an exchange traded fund. So don't freak out if you see the word ETP, or even I think ETNs are a thing as well. So don't worry, it's just exchange traded something. Just want to clarify that out. They should do what they say on the tin, but the costs that the ETP issuer experiences or goes through will probably be passed down to yourself. So don't expect exactly the number. What I wanted to put across, the key takeaway from this slide is that you should be focusing more on percentages rather than absolute numbers. So a 10% move in Tesla when holding this would result in a 30% move in your position. It could be up, it could be down, depending on if you're holding the long ETP or the short ETP, as mentioned in the title of the ETP that you choose to purchase. They're mostly done on single stocks. They're mostly also available in Europe. They're actually not allowed in America yet. Also, I feel so they're quite bespoke to the European market. Yeah, so you can get them on individual products. You can get them on the entire index in general. But that's typically the way it goes forward. You can also do them in terms of volatility. You can actually trade volatility. If you don't know what volatility is, please feel free to Google it. I don't think I'm going to go through what volatility is, just a bit too deep into the rabbit hole for this series and episode, so to speak. Right. So contracts for differences. We went through what they are. You get the difference in the settlement price between the period the contract is opened and closed. Right. So you make the difference of the movement, not the net movement, so to speak, and almost always cash settled. And the leverages range for products, as I mentioned. So I'm just going to open up my broker account. This is just a demo account with 50 grand in it, apparently. So I'm not too fussed about playing around. The reason they're grayed out is because today is the 2nd of April. As you can see, it's Good Friday, and I thought I'll just get this out of the way. So the markets, the US market, the UK market, almost worldwide, are closed right now. However, currencies are open, which is because they don't observe holidays, so to speak. So currencies are open. I think some other markets, if I go top winners possibly. So Japan 225, which is the Nikkei 225 index, is actually open. But the rest, as you can see, are all currencies. I'm not gonna bother. I'm just gonna use the Japan 225 index as a example. Hopefully, it's open as an example in this case, because the concepts would be the same. It's just the instruments that change, or the leverage that changes, not the actual fundamentals I'm trying to go through with you here. It's a bit odd that it doesn't have any squiggly lines. That's a bit weird. If I just try to open up a currency trade, yeah, that's a bit odd. I don't know why it's not actually moving a lot. Maybe there's no volume going on. I don't know. Anyways, cracking on. So you've got your sell to open price, you've got your buy to open price, the change in the percentage of the day, the high and the low of the day, so to speak. That's the changes over period. So again, as I said, the Nikkei 225 index. This is a contract expiring on the 10th of June. So you're actually looking at that's the contract you're purchasing. Market, of course, you're looking at Japan. The index futures, what you're looking at. If I go to the currency trade, Hong Kong, let's close that one. This would be Forex, which is foreign exchange. So that's what we're looking at. So you've got the details there. Minimum traded volume that you want to trade. So you can actually trade. Oh, there is a button there. There you go. So you can change the volume that you want to trade, and you can even type in what you want. So I think let's try zero point 0.1. Oh, sorry, my bad. Zero point 0.1. Yeah. So it's allowing me to trade that. That's just explaining the minimum exposure you can gain to what's happening. Oh, 0.01. Wow, so I can go further. That's just how much my broker thing I can deal with. That's the maximum number of positions I can open open and close, provided my account value and the margin provided by the broker. So the leverage here is 1 to 500. So a 1% move in this instrument would be a 500% move in my portfolio. Now it's of course unlike, because the leverage is so large, it's most likely for products that barely move around, or the movement is so small that they need to be magnified 500 times to be able to actually profit or make a loss off of. So that's why you have a heavy leverage, so that you can profit off of small movements in the best case scenario. And as I mentioned, the leverage and the margin are basically inverses. Now, I did mention the word margin and notional value in my previous episode, so I'm just going to explain what they are. Notional value is the cash value of the contract or product you're holding, right? So in this case, for example, in the case of Tesla, when you buy 10 shares of Tesla, uh, you're going to be holding 600 and something times 10. So in this case, let's look at that price. So $6,580 would be your notional value, 10 shares of Tesla, right? But if I open the Tesla chart, just for that, and explain, the margin here is 50%, which means my broker will lend me 50% for this position. So I only have to put up half the margin, half the amount of 10 shares, which would be half of 6580, around $3,300. And that's what the margin number dictates. You need to put up that much amount of the notional value of your position. So it's determined by your position and the contract value, and you to put up that percentage of whatever the multiplication of those two are. And consequently, because you're putting up half the value, you're getting 1 to 2 leverage. You're getting 2 times leverage. With the Japan, this one, you're getting about 500 times leverage. So that's about 0.2%. And that's your overnight interest that's being charged, 1% and 3% for short and long positions respectively. And that's the time that the interest rate is applied at every day. That's the expiry of the contract, the expiry time of the contract, and that's your market hours. That applies CFDs trade about, I think, what, 5 days a week, about 1 hour a day. So 5 days a week, 1 hour break. I guess that's what CFDs do. I don't trade CFDs, so again, I'm not very familiar with what with their exact um, workings, but I'm trying to explain the concept. So the concept of notional value applies across all products. If you buy one share of Tesla, your notional value is $658, and your position is also $650. Your margin is 100%. You have to put up 100% of your position size. So buying shares is basically buying stock at 100% margin. Your leverage is 1 to 1. $1 move in Tesla is $1 move in your account or in that position. I hope that concept comes across as clearly as I can put it through. Right. So yeah, again, buy to open. Let's drop in a position on the Euro USD. That looks way. Oh, there you go. We got a squiggly line there. So let's get rid of that. Let's get rid of all that stuff here. Let's go to the Euro USD. Same thing. I think the leverage would be the same. 1 to 500, 0.2%. And because the numbers are so small, 1.1, 1.1 dollars, or yeah, $1.1. So I can actually buy a lot more because I've got 50,000 pounds to play with. So let's go to let's try yeah, so you can actually, because you've got so much margin availability, you can actually go and buy and sell 2.5 million. Let's go 2 million actually, or 1 million. Let's keep the math as simple as we can. So sell to open. I just sold to open. That's a quick button there, so to speak. I didn't know about that until just now. So I sold to open a position. I'm instantly down because of the percentages and the fees that are going on in the background. Even though there's no commission, there are definitely fees in the background that work against you. And also, it is a bit. Oh yeah, so I'm a bit up, but because of the fees I've paid in the background, the interest fees and all that stuff, the buying in and all that stuff that goes in the background, that's not disclosed upfront. That's why I'm down almost instantly. Let's also buy to open a position. Or I have to enter quantity. My bad. Did not notice that. Let's buy to open a position. There you go. So these should effectively counter each other out. But because the interest rate is different, there you go. That's your interest rate. Because that is different, my short position is losing more money than my long, so to speak. I don't know why they're the opposite way around. Then I thought, oh yeah, okay, that's a minus sign there. That's why they're the opposite way around. That makes a bit of sense to me, kind of. So I'm long here because I bought to open a position. I'm long here on 1 million units of the Euro USD. So if the euro goes up, I make money. If the euro goes down, I lose money. And over here, I'm short, so I'm betting on the euro going down. And if the euro goes down, I do make money in the best case scenario. Right. So obviously, this is happening in real time on somebody's screen. Um, but obviously, because this is a commission-free platform, I can almost bet you it's delayed by a few milliseconds, so to speak. So the concept of margin, leverage, and notional value, keep that in mind as we take it across other products. But I think that's all I'm going to talk about in terms of CFDs. I'll let you, play around with them or explore them on your own time. That's not something I'm not interested in very much. So, right, options. So we had to rush through this last time, but options, you've got two choices. You've got calls and you've got puts. Hoping that calls are hoping at a number, at a value higher than the current price, and puts are, you bet for a number below the current price. And you've got your buy to open, sell to close, sell to open, buy to close applicable on both of these. So options give you 8 choices as opposed to 4 in CFDs, which is, buy to open, sell to close, sell to open, buy to close. Or let's compare them in pairs. So you can buy to open and sell to open a CFD, and you're basically being one-sided. You can only bet on one side. You can't sell CFDs to anybody. You can only buy CFDs, or you can only open positions as such, like that. With options, because you can bet on the upside and the downside, you have 4 total choices. So I said 8 previously because I considered, buy to open and sell to close as 2 different choices. But let's compare them in pairs. So you've got 4 choices when it comes to options. No pun intended here. I'm trying my best not to have puns going on. So the leverage is directly, because it's 100 shares you're controlling, more or less, asterisk on that. Your leverage is instantly 100 times. American options are the most famous ones. European options are possible on indexes. When I said, you remember when I said in one of my previous episodes, you can't directly invest in indexes, but options are a contract. So you can actually invest in contracts on indexes, but you can't directly invest on indexes as a one-to-one kind of thing. So also that's also what we just did with the Nikkei previously. We traded a contract on an index, but not the index itself. So don't confuse yourself with that statement. It's just an instrument on something. So in this case, I'm going to talk about American options particularly. um, let's get you directly into the weeds. Let's look at Apple. So the market is obviously closed. So this is Apple. This is a trading platform that I have no money in right now, but just a trading platform that's available. So options are on a particular date, as I mentioned. So let's just look at the definition once again. A buyer of the contract pays a premium to have the right but not the obligation, i.e., if they want to exercise the option, they have the choice, but they don't have to do it uh, at a predetermined price and a predetermined date, right? So options are typically sorted by dates, right? Let's open up the May contracts on Apple, so to speak. That's 49 days from now. Oops, sorry. And you've got your calls on the left and your puts on the right. And this is the predetermined price that you are betting on, right? So there's a in the money indicator there. That means anything below this, because Apple closed at 123. Quite ironic. That's funny. Closed at 123. Anything below 123 means these calls are an obligation from the seller's perspective. They have to sell these, sell whatever. If they sold a call somewhere in this region, they have to keep up with it. That's the seller who sold the call. But a buyer who bought these calls has the choice, but not the obligation to exercise their call option. So it would be silly not to do it, but they have the choice to not do it if they don't want to, right? So that's your in the money calls and your out of the money calls. In the same way, puts allow you to bet on the downside. So if the stock is any price below the actual stock price is out of the money, i.e., it'd be cheaper to sell in the open market than to exercise your put contract, because a buyer of a put can sell their stock at a particular price, right? So yeah, if I sold a 125 put, for example, then I am obligated to sell my shares at 135. Sorry, I'm as a seller of a put, I'm obligated to buy them, because the buyer of the put has the obligation to sell at 135, so to speak. Anyways, I'm going to try not to confuse you. And this is where the concept of bid ask comes into play as well. This is why I explained the bid ask concept so early on. It applies through shares, contracts, everything. And I think some of my loss in my CFD, which I mentioned just a couple of minutes ago, could also be the bid ask spread, which is just hidden away somewhere that I could not see on my on my screen at that particular time. So anyways, that's your bid ask. So if I want to buy a 135 call, the Apple is below 135. So I'm hopeful that Apple will hit 135 by May 21st. I will pay $153. This is because it's multiplied by 100. The number is has to be multiplied by 100. This is just per share, not per contract. Oh, yeah, I have just bid on a call. Yep. Yeah, exactly. Okay, okay. I'm sorry. I'm clear. Yep. So I can just buy this call for $154, and if Apple hits 136, then whoever sold me this call has to sell me their shares at 135. So I've instantly profited $1 per share times 100. However, I paid 154 for this contract, so Apple would have to be over 136.54 to for me to break even, to me for me to have a zero profit or loss. So if Apple goes to 138, then I've just made some money, so to speak, by the May 21st. However, if Apple stays somewhere in this region, anywhere above 135, this contract will expire worthless. It'll just disappear into thin air. I would have lost $154. Now the person who sold me this call is actually, let's take the other side, to be honest. Let's delete that. And again, 135, let's sell. So in this case, this person, it says green over. Oh, that's buy. Oops, sorry. Ooh, I have mixed myself up. Oh, this is so confusing. I'm sorry. Um, right, this is actually I'm selling one in this case. So in this case, I would actually I'm the seller of the contract, which means my maximum profit is 154, which is the premium I get for selling this contract. So I'm sorry for confusing you earlier. The previous concept still applies. It's just I mixed up the positions, and therefore I will have to put up 1260 as a collateral. All of this is because I think margin is enabled. So my broker thinks that that much money, which should be a variable number across time, that much money is enough to cover my position. Whereas if this was a cash position, I'd actually have to put up 135 times 100. So the notional value of this contract is 135, sorry, 13,500 US dollars. But my the margin that I have to put up is like around 10%, so to speak, or rather 10% minus my credit, right? So as you can see, these are metrics that are derived based purely on math and statistical models. There may be a black swan event where Apple just shoots to 200 for whatever reason, but in 81%, there's an 81% chance that this won't happen. That there's an 81% chance that I will make at least one penny on this trade. That's what I'm just going to go over, right? So that's the selling side of a call. Let's go to the buying side of calls. I've just bought. So I've bought. I've clicked on the ask price. So I'm willing to pay for the contract, and the bid price is I'm willing to sell a contract. That's how it works, I guess. I've never used this platform to such an extent previously. I've just opened it up for the demonstration purpose. Right. In this case, this is the other side of the coin. I've now bought a contract. So in this case, when Apple goes above 136.54, that's when I break even. So as I said, because I'm paying a premium, the only cost to me is the premium. And if Apple shoots off to infinity, if it goes to 1,000, my max profit is basically 1,000 minus my cost basis, which is the value of the contract. Sorry, the strike price plus the credit I've paid. That's my break even price per share. So if Apple shoots off to infinity, or let's say if Apple shoots off to 1,000, my profit will be 1,000 minus the combination of 135 plus 1.54 into 100, because each contract is 100 shares, although all these numbers apply to a single share, if that makes sense. So that's the call side. The opposite applies to the put side. So the out of the money here. So if I want to, if I sell, let's say, okay, let's click on that. Yep. So here I'm selling a $110 $110 put, right? So I am the sell side in this case. So I'm telling the buyer of this put, could be anybody, that I will sell you each share of Apple at $110. If I mean, for regardless of whatever happens as of May 21st, 2021, right? So my max loss here is if Apple goes to zero, right? So it's 110 plus the credit I receive. My and that's my maximum loss. If Apple goes to zero, I lose 110 plus the credit I received times 100. Sorry, yep, that times 100. That number is a bit different because oh no, it's not, it's correct. Yep, that makes sense. Yep. So it's basically 11,000 minus 131. That's my number. That's the maximum loss I can experience. My maximum profit is the premium I received from the buyer of this contract, and buying power effect. That's the amount of margin I have to put up, is 1,100 in debit. That's how much my broker will hold as collateral for this position while I have it open. Right, let's get rid of that. Let's buy 110. So in this case, I'm betting, or I'm hoping that the Apple would go down to 110 from its current price, which is 123. Right. So in this case, my max profit is capped between my current price 123 minus the combination of the strike price plus the credit I've just paid for it. So I pay 131. Strike price is 110. So 11,000. Sorry. Yep. So 11. So roughly around 11,000 is what I make. So because 123 minus 110 is about a 13 ish. Yeah, it's 13 exactly. Minus 1.31 times 100 is what I can make. Right. So the maximum I can lose is, of course, the credit I've paid. So this is a high. You're putting in less to make potentially more. In this case, the probability of profit is so there's an 18% chance that I will actually make 1 penny. So there's an 18% chance Apple will go down to 110, so to speak. So that's as you can see, you can buy and sell calls, and you can buy and sell puts. You can play two sides of the market. You can do whatever you prefer, and obviously it depends on your assumption of the market that you can choose your respective strategy, right? I think that's how the strategy would work. Right. So I hope that's enough to crack on with in terms of trying to get the point across of what options are. Futures, same as the options, but without the right. It's just the obligation. You have to buy the underlying at a predetermined price and date. However, futures are cash settled, so it'll just be money taken out of your account instead of actual delivery of oil, cattle, livestock, corn, whatever you want to talk about. So futures is an interesting one, right? So let's look at the okay. So I already pulled up a preset. So there's a futures available in the CME. Now, each future represents a different notional value because they all represent different units of the underlying, so to speak. So the ES is the E mini is the E mini S&P. That's the S&P 500 that you're buying a future of, right? So you can either buy or short the future. As I said, it's just two places you can be. You can so buying a future, you're buying that it will be worth this much, and like a CFD, it's traded in real time. Just ignore the upper screen for now. It's traded in real time, and if it goes up, you make money as per your leverage, and if it goes down, you lose money as per leverage. Same with the sell. You can sell the future contract, and if it goes down, you make money. If it goes up, you lose money. That's the two positions in futures. What I find really interesting, and this might blow your mind, you have options on futures, right? So again, this is the same that we've just discussed maybe 5 minutes ago. You can buy and sell calls and puts on future prices of futures. So you have the right, but not the obligation to take over the underlying future contract if you are in the money, right? And the point of in the money and out of the money is basically putting it simply, in the money means your contract is worth something. You will probably make money. You will probably have made a profit if your contract is in the money. And if it's out of the money means your contract will expire worthless if nothing happens and expiry day is today, for example. So if the contract are expiring today, in the money contracts are contracts which have a potential to be profitable, and out of the money contracts are contracts which will expire worthless on expiration day. That's basically the concept of in the money and out of the money. There's more to it, but that's what I'm going to try to justify or explain the point being across as. So the S&P hit 4,000 on Thursday, which was yesterday. It's pretty much an all-time high. Never been this high, which is the definition of all-time high. It's never been that high before. So that's the full future dealing with the E-mini S&P. Let's just look at futures. I've got so these are actually the future contracts. As I said, fixed prices, and the futures always tend to lead the market. So in this case, let's look at the June 21 future contract is about 4027. So the market has settled on the price of 4027, being the closing price of the S&P as of June 21st. Whenever the contract expires, I'm not sure when it does, on a particular day. Same for September 4016. You can see it's actually dropping a bit. So by March 22, which is about a year from now, the market is expecting the S&P to be worth about 200 points less than its current value. However, this could just be a case of liquidity. It could be no one is trading, or there are more buyer or more sellers of this particular contract than there are buyers. That could be just the case. So I wouldn't sell my entire position because I think this is going to come true. It may, but this is not exactly what's going to happen. These contracts trade in real time. So that's the case of futures. I'm just looking at S&P 500 for this case, but they're applicable to a lot of products. So you've got the Nasdaq. I think this is the Russell. No, that's the Dow YM. That's the Russell 2000. You got Bitcoin futures. I forget what this is. This is Australian dollar. I think these are all currencies. I think 6E is euro. If I know, yeah, it's euro. There you go. So I'm looking over here for the names. So euro. CL I know is crude oil, natural gas. I forget what GC is. Gold. There you go. GC is gold. And you got a bunch of them. So yeah, that's futures contracts. Let's minus that off. Let's get rid of that. uh, these are actually the futures available to people, and that's what their short forms are. So e-mini micros are basically a fraction of the e-minis. I don't know what fraction it is. I haven't looked into it. And then you got the e-mini Nasdaqs, micro e Nasdaqs, and then Dow, the micro Dows, and so on and so forth. You have on energy products. You've got it on metals. You got it on futures, corn, like corn, mini corn. Mini is basically a smaller version of corn, not actually smaller, corn itself. Soybeans, again, small soybeans, wheat, and so on. You've got currencies here, and interest rate, which is basically US bonds, so to speak. Let's get rid of that. This is the actual group that provides these products, the CME group. So I was looking at the WTI oil future. So again, the contract size, you're controlling the notional value of 1,000 barrels. That's your notional value, right? For one future contract of WTI oil. So that's the trading hours it trades in. I think futures is a 23-hour market, Sunday to Friday, 5 p.m. to 4 p.m. with a 60-minute break. There you go. It's available all across. You get options quarterly, monthly, and weekly. So you can also look up what other futures you want to look at. So this is just trying to explain to you what the notional value is of these contracts. So here is 50 times the S&P index. So S&P index is like 4,000 right now. Your notional value, your contract size is $50 times 4,000, which works out about 200 grand. That's the notional value you're controlling with one future contract. Just as an indication to you, these are the minimum ticks. Minimum tick is basically well, I don't know how to explain this to you. That's it's a bit difficult to explain ticks. I think you should Google that value. But the dollar value of each tick is that much. So one tick movement, I think a tick is a lot like basis points. So basis points is 0.01%, just in case people don't know. Uh, yeah, each each tick would result in a $12.50 movement in your position. So you have to have the collateral more futures are mostly traded on margin, but if you're trading in cash futures, which is very unlikely, almost it's very difficult to do that. If you're trading in cash futures, a tick movement would be a 12.5 movement in your in your position to hold it. Right. So that's futures, and I spoke about options on futures. uh, yeah, I think there was one more bit I wanted to discuss. Oh yeah, swaps. I'm not going to go over. It's basically, I think I did try to explain it as best as I could last week, but I did make a lovely little table. So bullish is hoping the mark, you make money if it goes up. Bearish is hoping is you make money if your underlying goes down. So buy to open, sell to close, sell to open, buy to close for CFDs. When you buy to open, you are being bullish. When you sell to open, you are being bearish. Same with futures. If you buy to open, you're being bullish. Sell to open, you're being bearish. Options is where you have a two-sided market. You can play both sides of the coin if you want. So calls is when you buy to open, you're being bullish. Your hope you will make money if the underlying goes up. Puts, you will lose money. Only your premium that you paid for your put, if you're buying a put, you will lose money if the underlying goes up. So you will lose your entire premium. Your contract will expire worthless because it's out of the money. Right. Selling your options, the whole different thing. So selling a call is you will make money if the underlying goes down, right? Because then your contract, the contract you sold, will expire worthless. So you are actually a bearish on a call, on a sold call contract, right? And the potential for loss in a sold call contract is infinity. Literally, if the stock hits 1,000, if you sell a Tesla call at $1, you have to sell someone the Tesla share at $1, and Tesla share could go up to 10,000. So your loss is the entire range of 10,000 to $1 times 100, because it's 100 shares. Again, likewise, if you sell a put, you are hoping that the underlying goes up so that your contract expires worthless, and you can keep the premium. So the buy to open in this case pays the premium, and the sell to open receives the premium. I hope that makes sense. So these guys down here take on a limited amount of money. They take on a little income for a sorry they take on infinite risk for a higher probability of profit if they sell out of the money calls or puts. And these guys here, they take on little risk, which is the premium they paid, for the potential of an infinite gain. But that infinite gain comes with a very low probability of profit unless a black swan event happens. So the amount you put up is more or less inversely correlated to the percentage of profit that you can make. So with CFDs and futures is literally a 50-50 shot. You don't know where, nobody knows where this is going, not the gurus, not the CNBCs, nobody. uh, but whereas options are priced on a more statistical model, except black swan events, and you can apply mathematics to how options work to work either in your favor or against you. But however, people who bought the March dip, whoever bought calls in the March dip, they really minted money. People who sold puts expiring in Feb also did make money. But anybody who sold a put in March or March 1st lost money because of the whole dip. Whereas anybody who sold calls during the March dip of last year actually made money. So when I said March dip, I'm talking about last year, 2020. And that's how I hope I put across what these instruments are. They are quite complex, and you can get lost in them. You can lose a lot of money really quickly. So it's just something you need to expand your opinions and your horizons on, and hopefully educate yourselves to improve your chances. Should you decide to look into derivatives again, I'd look into these references if you feel like looking into. None of these talk about options that much because they're so rare, or futures, or CFDs. But I really urge yourself to look into these instruments before you actually invest any money in. Anyways, yeah, I wish you the best of luck. And again, if you need me, you've got me on socials. And I haven't decided when the next episodes will be, but this is just an annex video to my previous week's video to try to explain the concepts all of well, to explain the deep level. Yeah, I hope you understand and learned a bit today. And I'll see you around next time. Yeah, have a good one, guys. Thank you.